Lovely. So we're now streaming live, and today is set to be a pretty monumentous day for commercial property, for retail, for the economy post COVID. The last week or so, as many of us will be aware, Intu have been in some challenges for a while, and Susie's going to give us a bit of insight into that. Last week, KPMG were instructed to basically stand on the sidelines and wait to catch it if it falls. And we're approaching the Friday deadline today. So today will be the last port of call to decide whether Intu can turn itself around, restructure its debt, put something in place, or whether one of the largest shopping centre groups in the UK actually falls into administration. And obviously, that is such a significant thing to be happening right now. We all know there's going to be huge change in the property market. There's going to be fundamental changes in the economy, lots of shifts and changes. But for a group this large, we knew that individual retailers were struggling, but for the shopping centre group that actually looks after them, for that to fall into administration, the impact's going to be huge. But equally, with every challenge comes huge opportunity, and this is another sign of the gold rush that we're talking about. End of this year into 2021. There's going to be huge change, but huge opportunity. Susie Carter is becoming a very good friend of mine. We've been talking a lot about commercial property recently, and she is a property entrepreneur, a commercial property consultant and expert, and she's the best person that I personally know to advise us on what's happened, how did we get here, what is going to happen, and obviously the impact this is going to have on the economy. So, Susie, thank you very much for joining us.
That's okay, my pleasure. Good afternoon.
Yeah, good afternoon. What a day.
It sure is, yeah. It's if you'd said this even a year ago, this would happen today. It's pretty you'd never have predicted it.
No way. And even when we talk about zombie businesses, these companies that have been on life support for the last few years, and COVID's sort of given them the final bullet, like some of the Arcadia Group, things like that, that really were due to go out of business. Something as significant as, where does Intu rate in the commercial space as a player? Someone that big to be able to fail. It's like when the banks fail, you think they're too big to fail. Today they could actually go into administration. How big are they in the commercial space?
Yeah, if you take them as a kind of a retail owner, they're probably first or second, probably second to Lancet in that space. They're a stack of prime product actually. So lending and banks aside, if you were saying that any shopping centre group was going to go down, you'd probably say it was someone who owned a load of secondary shopping centres. But actually, they own probably some of the most prime shopping centres in the UK. So you've got Trafford Centre, the Arndale Centre in Manchester. You've got Merry Hill, Cribbs Causeway, St David's in Cardiff, Metro Centre. This is prime product.
Yeah, I live in Nottingham, and both of us, we've got two shopping centres, the Victoria Centre and the Broadmarsh. Both of those are Intu. Both have been, Victoria Centre was refurbished only 2 years ago. The Broadmarsh is mid-demo at the minute. They've knocked it down. It's part of the £10 billion regeneration of Nottingham City Centre. Derby, the big shopping centre is Intu there. It's been refurbished. How have we arrived at a place where only 6 months ago, they were refurbishing and developing and running some of the best prime shopping centres in the country to, in the next 3 hours, they could go into administration?
Well, I think this is an absolute classic in terms of, as you know, Dan, as an expert in economics and kind of cycles and stuff, is that it's an absolute classic demonstration of how investor confidence and the confidence of lenders is affected by kind of what's happening in the world around us, world events, etc. Because Intu have taken on a lot of debt over recent years, and they've had a really complicated debt structure as well. So it's not just that they're kind of highly leveraged; they have got a really complicated debt structure with various kind of banks, etc. And they were bought out by, or a major shareholder is John Whittaker of Peel Group, who kind of got involved about, I guess, 6-7 years ago. He owned the Trafford Centre and obviously brought it into that group. But yeah, so it's a classic case of you can have the most prime property and you can have the best business model ever, but if you're over leveraged and the market starts to go down or collapses as it has done with COVID, then this is the consequences of it. So I'm sure that they've I'm sure they've been trying to desperately to restructure, but if the bank's confidence has gone in the business, it's very challenging, isn't it, to see where they can go?
Without a doubt, you and I were talking on one of the property entrepreneur calls. I can't remember which one it was, but I remember we were talking. In fact, no, I was doing a presentation about the commercial market, and I was talking about the share versus the asset value. The fact that the share value was significantly lower than the asset value. And the Warren Buffett strategy is to look for undervalued assets, and you look at that and you think that looks like a phenomenal opportunity. But that was only 3 or 4 weeks ago, and we saw where it was going. How did their, even in sort of like 6 to 12 months ago, they obviously invested heavily. How did their balance sheet look? I know they had about £4 or £5 billion worth of debt. Was that against £1 billion worth of assets? Or I'm assuming their asset base was quite significant.
Yeah, the trouble has been in this sector is that it's been like death by 1,000 cuts by the valuers of their portfolios. And not just their portfolio, it's every owner of shopping centres will relate to this. So what's happened over the last probably 3 years, I would say, valuers don't like to make a big swinging cuts to values. What they like to do is kind of death by 1,000 cuts. So they'll just be chipping bits off the portfolio value. But cumulatively, obviously, that comes to quite a significant reduction in asset value. And I think when we were talking 3 to 4 weeks ago, they were trading at 97% discount to asset value, which is insane. But then if you put it in the context that people like Lansec, Hammerson, big shopping centre owners in the UK as well, they're trading about 50% to net asset value. You can see kind of that this is a sector-wide issue. And I think that Intu have been affected because of their bank structure and their lending structure, rather than kind of, the fact that they've bought the wrong assets or whatever.
Yeah, I understand. What's actually happened? So they've got a portfolio, let's say even on the balance sheet, they owe 4.5 billion, their asset value is maybe getting chipped away. What's happened in the last, KPMG were instructed last week. What's happened over this period that's made them actually get to that point where they think this is in real trouble? Have they not got the capital to pay the overheads? Understand commercial rents last quarter came in at like 15 or 20%, was it? What market factors, to give everyone a broader view of what's happening out there, what contributes have triggered to such a Goliath property group facing administration?
Well, if you take a shopping centre owner, what happens usually, if the world was normal, which obviously it hasn't been in the last kind of few months, what usually would happen is that most of your overhead, so you've got tenants paying rents, you've also got them paying the service charge, which contributes to the running of the shopping centre, and you've got them paying their insurance. So you're relatively cost neutral. In fact, the idea is obviously you're making a profit, a significant profit, because you've got all the rents coming in and all your costs are being covered by the outgoings on the leases. But obviously what's happened is that rents aren't being paid now. And so, and I suspect, I don't know, but I suspect service charges perhaps not as well. And because there's no evictions, and obviously, a lot of the big brands have basically said, and this just isn't just Intu, this is right across the piece. A lot of the big brands said, well, we're just going to ask for a rent free. So it's not even that they're going to pay back later. They're actually saying, we just want a rent free for a year or whatever. And from a cash flow perspective, if you're very highly leveraged and you've got bank debts to pay every month, then that's just going to tip you over the edge because you haven't got any money coming in. And this is happening to landlords right across the country. I think some early stats from this quarter. So quarter day was a couple of days ago. I think some early stats that around 15% of retail rents have been paid. I mean, those figures are just staggering.
You literally can't run a business on that.
Exactly. So and obviously what will have happened side by side that is that valuers will have come in, and commercial property portfolios are valued pretty regularly. So valuers will have come in and said, well, the market's gone to pot, so we're going to down value. That the effects of that hasn't played out yet. I think that those kind of valuation reductions will carry on. But I kind of read this morning that there's been £2 billion worth of value wiped off its portfolio. So I think the whole group is worth about 52 million now. And if you think that they've got billions of pounds worth of assets in there, it's just insane, really.
It is crazy. I mean, when I was looking at I can't remember what I was looking at, but I remember when I don't know where I got the figure from, and you feel free to correct me, but I'm pretty sure when they grouped up or changed hands or raised finance, the most recent figure that I remember, which was some time ago, but it was £2.50. They were trading at. And then I just thought, out of interest, I looked yesterday and they were trading at less than 50p a share. And you just think, it's crazy. Like, it's absolutely crazy.
And sorry, Dan, £2.50 was cheap to where it was maybe 7-8 years ago. You know, it was kind of in almost 10, I think, something like that.
Yeah, it's indicative of what's happening. And this, whilst all this stuff sounds negative and everything else, on Property Entrepreneur, all we're talking about in a minute is this is a very exciting time because there's change, there's challenge, there's huge restructure, and some areas of business are not going to come back. Like some areas of the high street, of commercial, we'll just have to fundamentally change. And I showed you a video of Rishi Sunak answering questions in the Commons, and people were saying, what are you going to do to fund the high street? Can you give them a grant to cover their rents for a year? And Rishi Sunak, who's the Chancellor of the Exchequer, and granted, and credit to him, probably one of the strongest candidates we've had in that seat for as long as I can remember, he knows how to play the game. He knows how to do this. His feedback was some problems just can't be solved with money. And he was saying, what we need to do is look at fundamentally change the high street, the commercial space, and actually not invest in, keep it going. Let's not have another zombie business. Let's change it. Let's look at planning legislation. Let's look at permitted development. And Susie actually shared with us yesterday the first phase of this coming out. So without a doubt, we're heading into one of the best times in history. I've probably got two sort of areas I'd like to ask you about, Susie. One would be, it looks like Intu are going to go into administration today. In real terms and economic terms, what does that mean commercially? I mean, are they going to close them down? Is it going to be job losses, I'm assuming? Is it going to in turn actually suffocate the last bit of life out of those businesses that trade in those centres? What's going to happen in real terms as a rippling effect? And then I'm going to ask you what opportunities we might see.
So I would be very surprised. I mean, the press is saying there's going to be closures, but if I was KPMG, I would be saying, well, if we close the centres, then you're not going to get any rent coming in, are you? So, and actually
throw the baby out with the bathwater.
Exactly, yeah. So, and also there's lease clauses they have to comply with. They have to provide a running centre, etc. So, they're going to have to be really careful on that one. And so I would suspect what will happen is that they will stay open. They may close temporarily, but they'll have to open again pretty quickly. Now, if they close, all that will happen is that there'll be lawsuit after lawsuit from retailers who just want to just throw the keys in and exit their leases, go somewhere else. Because what's the point, especially in this environment, of a retailer being in a centre that's closed? You've been closed for 3 months. You want to be out and you want to be trading, don't you? So I think it would be very surprising if that happened. But obviously, I've been surprised a lot over the last 3 to 4 months. So you never know.
Without doubt. I've got a reasonably clear picture of how this is going to play out. But these big businesses, you do think they're too big to fail. You just think they're fundamental parts of our, I don't know what you want to call it, society, economy, towns and cities. They're just there, and you just assume that. But they're a casualty of, I suspect, this model that's been on borrowed time of these leases. With only upward reviews, fixed rates. There's no footfall calibration to sort of take the rough with the smooth. So landlords have had their good run, and now it's going to change.
So, sorry. I was going to say my favourite quote at the moment is the old capitalist Karl Marx. He said there's decades when nothing happens, and there's weeks where decades happen. And I mean, the retail basically, as you've talked about on Property Entrepreneur, it's we're basically seeing 2030 and 2020 now. If this hadn't happened, we'd have seen failures every year, and it would have kind of died a bit of a death. All that's happened is that everything's been accelerated now. So basically, what was going to happen has happened anyway. In one way, and I'm a real optimist, in one way that's a real opportunity, because actually what retail property owners, property companies can now do is kind of almost take the hit and move on. and kind of and reinvent themselves, but they're going to have to seriously reinvent themselves. Retailers are going to have to really reinvent themselves, because people can shop online, so why would you leave the comfort of your front room? So it needs to you need to have kind of retail with with excitement and interaction and experience. And then as you said, there's going to be a move to turnover rents, so where the landlord basically shares in the success or the failure. So other retail landlords will be looking at this with trepidation and interest, because it will first of all meet the down valuation of a lot of shopping centres in the UK. It's just going to, because that's the way valuations work. And secondly, it's going to accelerate even more what was going to happen, but it's going to bring the pain forward of what a lot of people are looking at. Of course, some might be happy because some retailers might move into their centres. So there's always a silver lining.
Yeah, without that. And one of the things that we've been looking at on Property Entrepreneur is the finance market, and saying how, and I completely agree with your analogy of a decade happening in a day. And it's a good thing. It will completely reset the bar, it will clear the landscape, and for us entrepreneurs, it will be an entrepreneur's playground, because the government are going to put stimulus in after stimulus to encourage us to do stuff with it. What do you think this will look like in 6 or 12 months? Do you think they'll just reset the bar with the debt, wipe it off the balance sheet, and just put a new model in place to keep it going? Or are we going to see fundamental changes in shopping centres becoming whatever, development projects or entertainment venues? Or how do you see this playing out? Is it just going to be a restructure of the finances behind the scenes? And obviously, this debt, a lot of this debt is private funds, or it can even be pension funds in commercial space. There's going to be a lot of impact on the finance market as a whole. If, just to finish, we focus specifically on the actual asset class, these big building centres, which are purpose-built, we're all familiar with, how do you think they're going to look in 6, 12, 18 months? Do you think they're going to be the same and just the finance will be restructured? Or do you think we're going to see a fundamental shift in the use of those sites?
So I think that, well, first of all, I think that Intu's properties will be broken up and sold. So if I was a real estate investment trust or whatever, I'd be looking, and I'd set my stall out to specialise in retail, and I probably would be buying one or more of these, off the market. In terms of other shopping centres, I don't think that change can happen that quickly. So I've said for quite a long time that I think there's a two-tier market. There's the destination centres that have definitely been moving more towards experiential type shopping centres for a while.
Like the escape group and things like that.
Yeah,
you've got
exactly.
You got snow skiing, and you got parachuting, all that sort of thing.
Yeah, exactly. And there's a reason why leisure parks have had a massive resurgence over the last 5 to 10 years as well, because if you're going to leave your sofa, you want to experience. So that's why retail needs to pull its socks up, frankly. So I think the destination centres will do okay. They're going to suffer crippling voids. Don't forget that a lot of the big owners, other than pension funds, are kind of in the FTSE. Well, they were in the FTSE 100. So they're big real estate investment trusts, etc. So they'll have shareholders to answer to as well. They'll be needing to voice their share price by putting some really clear plans in place as to what they're going to do. In terms of secondary shopping centres, I think that they're going to be developments. I mean, I can see that a lot of those will cease to exist. Maybe not in 6 to 18 months, maybe kind of a bit longer. It just depends. There's going to be resi above. There's going to be complete repurposing. I wouldn't be surprised if suburban ones will turn into more office space, ironically, because of
we'll come full circle.
Yeah, the need for kind of local hubs, because people will be working from home. Suburban office space could be quite interesting. So yeah, it's going to be really interesting, but definitely I would say kind of the secondary end is where the development opportunities are going to lie.
Yeah, and without it, I mean, maybe not that scale. It's definitely outside of my experience and appetite, but the commercial space has got to be one of the #1 spots for the 12 months ahead, with high street changing, the shifts in customer spending, adjustments in planning reform, permitted development, all these little mechanisms we're aware of. And it is going to be an entrepreneur's playground. This gold rush is very much going to happen. Probably a couple of things to finish. If you were to maybe offer a couple of sort of key areas for people to be looking at into the 12, 18 months ahead with regards to opportunities, or maybe even risks, maybe biggest risks, biggest opportunities. Which sort of direction would you focus people's attention to as where there is going to be some real changes and real opportunities for us to capitalise?
So I think don't go too early on retail if you're going to buy it. Obviously, if the deal stacks now, that's one thing. But if you're looking for bargains, don't go too early, because my view of the market now and kind of all my agency contacts is that the pain hasn't been realised yet. So, you know, there's no real, well, there are some bargains, but maybe more if Intu goes today. But, you know, towards the end of this year, next year, I think that's where the kind of buying opportunities will really sit. In terms of risks, I always say have multiple exits, because you know, there's a reason why a lot of the banks aren't lending on retail now, because they feel it's too risky. And so you know, having multiple exits. But you know, if you've got a really clear commercial to resi angle, and I'm thinking about all the new PD rights that Rishi and gang are kind of going to be bringing in. So you've got potentially air rights coming in. You've got a much smoother path from retail offices to residential. I suspect the prior approval process will probably be sped up. You know, there's going to be a stack of changes. So if that's kind of your space and that's where you want to exploit, that is a massive opportunity. And I think the local authorities are going to have to stop. You know, they've been very rigid about their high streets and kind of saying, you know, this is going to be retail and you can't do anything else with it. And I think that especially on secondary areas, they're going to have to be a lot more flexible. And I just hope they are, because otherwise, you know, town centres are going to stagnate even more. But as you say, amazing opportunities there.
Yeah, a shared excitement about it. We've been doing commercial, retail, a little bit of sort of high street stuff for a few years, and the planning's been challenging, but they have been quite lucrative. You've had sort of shop fronts, and they say, you know, you've got to leave at least 8 square meters or whatever it is at the front, because there might still be an opportunity. Like, this has been empty for 5 years, nobody's in there.
Yeah.
With the new planning reforms, potentially centralising some of it, if they do really want to really gear things up. So yeah, it's very, very exciting. And yeah, retail is going to be a key area. And yeah, glad to have you on Property Entrepreneurs so we can explore the journey together. Any closing sentiments or information you want to share? Things I forgot? How people can reach out to you?
Yeah, sure. So I have a website which has got a free webinar actually on kind of COVID-related issues and where the opportunities might be in the commercial property sector. So if anybody's interested, it's www.commercialpropertyacademy.co.uk.
Very good. I can't recommend Susie Carr enough for the commercial space. I've got a handful of friends that I talk to about commercial, and there's very few that have got the experience and expertise in this space and across the whole spectrum of commercial at every level. So if you're as excited as we are, I encourage you to reach out to Susie, find her on Facebook, watch that webinar. Susie, thank you very much for joining us today, and let's see what the rest of the day brings. Who knows? But I think KPMG might have a busy week ahead of them next week. So thank you very much for your time. I wish you the best for the weekend. I'll catch you again soon.
Thanks.
Take care, Susie. Cheers.
Cheers.